At 9:30 in the morning on August 1st, 2012, one of the most respected trading firms on Wall Street was worth over $1 billion. By 10:15, 45 minutes later, it was effectively dead. No fraud, no rogue trader, no market crash. What killed Knight Capital was a single, forgotten step in a routine software update. And here's the part almost nobody talks about. When their engineers tried to fix it, they made it dramatically worse. To understand how a company can lose nearly $500 million before most people finish their morning coffee, you need to understand what Knight Capital actually did. Knight was a market maker, one of the biggest in America. When ordinary people bought or sold stocks through their brokers, there was a good chance Knight sat on the other side of that trade. On a normal day, its computers handled billions of dollars in orders, executing trades in fractions of a second. Speed was the entire business. Knight's systems competed in a world where a millisecond of delay meant losing money to a faster rival. At the heart of it all was a piece of software called SMARS, the Smart Market Access Routing System. Think of SMARS as a dispatcher. Big parent orders came in the top, and SMARS sliced them into smaller child orders and fired them out to the exchanges. It had been running and evolving for years. And that's where the first seed of disaster was planted, nearly a decade earlier. Buried inside SMARS was a module called PowerPeg. It was old test code, built to deliberately buy high and sell low in a controlled environment, pushing prices around to verify that other systems responded correctly. It was a crash test dummy, never meant for real roads. Knight stopped using PowerPeg in 2003, but the code was never deleted. It just sat there, dormant, waiting. Fast forward to the summer of 2012. The New York Stock Exchange was about to launch something called the Retail Liquidity Program, and Knight wanted in from day one. Their developers had about a month to write and ship the new code. Under deadline pressure, someone made a decision that would seem harmless to almost any engineer. Instead of creating a new flag to activate the new feature, they reused an old one. Specifically, the flag that used to trigger PowerPeg. Reusing the flag meant one thing had to be true. The old PowerPeg code had to be gone from every machine before the new code went live. If any server still had the old code and saw that flag switched on, it wouldn't run the new retail program. It would wake up the crash test dummy and put it on a live highway. Remember that, because the entire disaster comes down to the word every. The last week of July 2012, a Knight technician began deploying the new code. SMARS ran on 8 servers, and the update had to be copied to each one by hand. 7 servers got the new code, the 8th one didn't. There was no second engineer assigned to double-check the deployment. No automated system verified that all 8 machines matched. One person, one manual process, one missed server, and nobody on Earth knew. August 1st, 2012. Market open, 9:30 a.m. The Retail Liquidity Program went live, and orders tagged with the repurposed flag began flowing into Knight's systems. On 7 servers, everything worked exactly as designed. But every order that happened to route to the 8th server hit the old code path. PowerPeg woke up after 9 years of sleep, and PowerPeg had one job: buy high, sell low, as fast as possible, forever. There was one more fatal detail. Years earlier, Knight had moved the code that counted filled orders, the part that told PowerPeg when to stop, to a different part of the system. On that 8th server, PowerPeg couldn't see its own trades completing. It was a machine designed to lose money on purpose, with its off switch unplugged. It received 212 parent orders that morning. From those, it began firing out millions of child orders into the open market. Within minutes, Knight was buying millions of shares it didn't want, in 154 different stocks, at prices it was guaranteed to lose on. The volume was so absurd that traders across Wall Street noticed instantly. Stocks with no news were swinging violently. One stock traded more volume in 20 minutes than it normally did in a week. The New York Stock Exchange called Knight to ask what was going on. Inside Knight, it was chaos. The firm was hemorrhaging money at a rate of roughly $10 million a minute, but nobody could see where it was coming from. The new code had been tested. The dashboard showed the retail program working. In fact, The system had been sending out warning emails since before the market even opened. 97 of them, flagging an error on one server. They went to a handful of inboxes, unread, treated as routine noise. And now comes the twist. The decision that turned a serious incident into an extinction event. Knight's engineers reasoned the same way most of us would. We just deployed new code. Things are breaking, so roll it back. They reverted the 7 good servers to the old version. But the old version was the one with PowerPeg in it. Instead of one server running rogue code, there were now 8. They hadn't contained the fire. They had spread it to the entire building. For 45 minutes, Knight Capital executed over 4 million trades, moving nearly 400 million shares through the market. By the time engineers finally identified the 8th server and shut the system down, the firm had accidentally accumulated positions worth billions of dollars, stocks it never intended to own, bought at prices no sane trader would pay. Unwinding that mess locked in a loss of around $460 million. Knight's entire cash reserve was about $365 million. Here's what makes this worse. The safeguard that could have stopped it in seconds already existed at other firms. A simple kill switch, a circuit breaker that halts trading when losses cross a threshold, was standard practice at many trading shops. Knight had risk checks, but nothing that could automatically pull the plug on SMARS. Humans had to find the problem, understand it, and act. In a business measured in microseconds, their response time was measured in coffee breaks. The market's verdict was instant and merciless. Knight's stock fell 33% that day and kept falling, down roughly 75% within 2 days. Clients pulled their order flow. The firm that had survived the dot-com crash, 9/11, and the 2008 financial crisis was brought to its knees by a copy-paste job. Within days, Knight was forced to accept a $400 million emergency rescue from a group of investors, survival in exchange for most of the company. A year later, what remained was merged away. Knight Capital, as an independent firm, was gone. The SEC's investigation read like an engineering horror story. Dead code left in production for 9 years. A feature flag recycled instead of retired. A manual deployment with no verification and no second pair of eyes. Warning emails nobody read. No kill switch. Any one of those fixed would have prevented or contained the disaster. Knight was fined $12 million, but the fine was a rounding error. The real penalty had already been paid at $10 million a minute. The lessons outlived the company, and they now shape how serious software gets shipped everywhere, not just on Wall Street. Never reuse a flag that once meant something dangerous. Delete dead code, because code that can't run can't hurt you. Automate deployments, because humans miss step 8 of 8. Treat alerts as alarms, not wallpaper. And always, always build the kill switch before you need it. Every one of these rules sounds obvious. Knight's engineers were some of the best in the industry. The most unsettling part of the Knight Capital story is that nothing about it is exotic. There was no genius hacker, no once-in-a-century event, just ordinary shortcuts, the kind taken in codebases all over the world, every single day. The difference is that most systems fail quietly. Knight's failed at the speed of the market, in public, with real money. Somewhere right now, a piece of dead code is sitting on a forgotten server, waiting for someone to flip an old switch. The only question is what it's connected to.